You're about to hear my conversation with Will Aldridge, co-lead of the North American Equity and Income Boutique, and Tim Johal, lead manager of the Mackenzie Canadian Dividend Fund. During our conversation, we'll talk about how financial markets have reacted to a Mark Carney minority government, what both portfolio managers are watching during earnings season, and some details on the medium to long-term opportunity in the Canadian energy complex. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, head of portfolio construction in Mackenzie Private Wealth. Today, I'm joined by Will Aldridge, co-lead of the North American Equity and Income Boutique, and Tim Johal, lead manager of the Mackenzie Canadian Dividend, and we're going to talk about Canadian equities. Will and Tim, thank you for joining the podcast today.
Thank you, Rajan.
Great to be here, Rajan.
Excellent. Now, I'm going to jump right into my questions. Now, gentlemen, we're just a few days really removed from the results of the Canadian election. The election's certainly finally in the rearview mirror. I'm curious, from an investment perspective, how would you characterize the results of the election or just the reaction of financial markets to the results that we have received?
I'll take that question. If you look at the reaction of the markets, capital markets in general, they're actually relatively muted. That would be true across equity markets, fixed income markets in Canada, and even the currency market. The Canadian dollar was little changed after the election relative to the U.S. dollar. I think there's a number of reasons for that, Rajan. I think Mark Carney was ahead in the polls for quite a while, and the markets had time to consider that. That'd be number one. Number two, I think the minority government aspect puts a bit of uncertainty on which way the platform will evolve and how it'll evolve. Minority governments do put a bit of a wrench in trying to achieve a policy objective. So we'll have to wait and see which way that policy platform goes and how it evolves. And then number three, I would say that Mark Carney did campaign on many pro-growth policies, has a pro-growth agenda, and which is very different than the previous Liberal government. So I think again, the market here is taking a wait and see approach. Mark has committed to new infrastructure spend, new spending on pipelines and energy, renewable energy, and more than likely fossil fuels. And so the market is just waiting to see how that plays out. Now, the other kind of wrinkle in all this is that minority governments in Canada tend to only last about 2 years before an election is called again. In the last government under Trudeau, Trudeau had an agreement with the NDP, which allowed him to stay in power longer, if you will. But that's typically not the case. We have had several minority governments in Canada, and a 2-year window isn't, a very long time frame to pursue an agenda. So I think the market again is taking a wait and see on a lot of things here.
That's excellent, Tim, and it is a perfect way to begin and frame our conversation. Will, I'm going to turn to you for my next question. From your perspective, how would you characterize overall sentiment towards Canadian equities right now from the investment community?
Yeah, thanks, Rajan. Well, we've been through a lot, I will say, certainly. And sentiment's a hard thing oftentimes to put a pin in. And I think no harder than now, for sure. It's been challenging, I think, for investors to try to understand what has been driving markets, what will drive markets going forward. And so therefore, suggesting what sentiment may be going forward is certainly a challenge. I think let's look back a little bit, though. Let's think about how the Trump administration started. Investors were bullish, I think, coming out of that election result, thinking that markets were poised certainly for stronger earnings, stronger sort of growth across North America. And then if we think about what happened on, I believe it was February 3rd, when we got the initial tariff announcement from Trump around the 25% tariffs on Mexico and Canada, that certainly was a surprise. So I think at that point in time, sentiment was actually quite negative on Canada and Mexico as well. Since that point in time, then we've had Liberation Day. If we think about coming out of that, Canada was kind of skated through in a sense, not unscathed, but certainly not as punitive as what we saw for other countries. So um, in general, as Tim just pointed out, it is a bit of a wait and see right now. I think sentiment on Canada in particular, sort of the nationalism that we naturally will feel as a result of how we've been targeted by Trump, I think has been favorable for Canadians thinking about the opportunity to invest in Canada. It's been a number of years for Canadians to look at Canadian stocks and say, there's a great opportunity here. I mean, the U.S. has been the place to be based on the tech sector driving markets generally, and we don't, of course, have a tech sector in Canada. If we think about the Canadian market, if we think about the composition of the Canadian market, we think about gold. The only place to play gold is Canada, so Canada definitely is in favor from that sense. Energy, obviously, on the other hand, has been tougher. So we've got these two components on the resource side, which have been sort of offsetting sides of the coin. Then, if we think about banks, big part of our benchmark as well. Banks are effectively a proxy for the Canadian economy. The banks have held in reasonably well. And I think to that extent, people are looking past some of the near term noise and saying, in the long run, as Tim just pointed out, the opportunity for Canada we think is great. And the banks are a proxy for that as well. So we're poised for greater investments into Canada, whether that be on the energy sector or any other file. And I think Canadian companies are poised to start backing our country as well. And we've seen that from some companies that we invest in.
Very good, Will. Those are very insightful comments with regards to sentiment. I'm going to stay with you for a moment because we are talking about sentiment, and few things can shift sentiments like actual earnings. And we're getting into quarterly earnings in Canada. Beyond the financial metrics you're obviously looking for as a portfolio manager, what are you looking to learn from management commentary in this particular quarter?
Yeah, I think the big thing we're looking to hear is how they're positioned to manage through the uncertainty that Tim alluded to. It is highly uncertain. We don't yet know the rules of the game. And yet, at the same time, management teams need to drive their businesses forward. And we are certainly starting to hear that. If we think back to the earlier part of the year around that February 3rd announcement, I think management teams generally were very surprised, as investors were, as I've just mentioned. So they've taken that from that point in time to today to analyze the situation, think about the opportunities, and then think about how they can divert business if needed away from obviously the market that we're primarily dependent on, the US market. And we're starting to hear that. We've just started Q1 earnings here in Canada. We're a little bit later typically than the US in companies that come out and report earnings, but we're starting to see that. CP Rail, for example, just reported the other day, they're thinking about opportunities to drive incremental business between Canada and Mexico. As the CEO of the company put it, bypassing the middleman. That's how they're thinking about this. Whether it be Mexico, whether it be Europe, I think Canadian companies are looking at diversifying away, if need be, from the US. We're always going to be dependent on the US, just based on geography. There's no question about that. But I think this opens up an opportunity, not to be crude about it, but we need a bit of kick in the butt, I feel, a little bit of a kick, a little bit of a push to say, hey, you've got a great business. How can we exploit that great business and look to drive it forward to the next level? And I think this is how companies are thinking about positioning for the next few years here in Canada.
That's very good, Will. Tim, I'm going to stay with that train of thought and turn over to you. Will provided some examples of Canadian companies actually talking about diversifying away from the United States. And in your opening remarks, Tim, you made reference to the opportunity we have with our natural resources in Canada. All this talk about Canada diversifying away from the United States or Canadian companies doing so. What are your thoughts on this narrative?
Yeah, thanks. I go back and I think about, what made Canada wealthy. And I actually think that, our vast natural resources account for a lot of the reason why we are a wealthy nation. And, I think we need to be able to continue to enjoy those natural resources that we have been blessed with and that the rest of the world needs. And I think we can do that in a very environmentally friendly way, more so than we've done in the past, And I think you can have both. I think, the rest of the world, as I said, needs our natural resources, and we have plenty of them. And there needs to be a change of thinking around that. And Mark Carney has seemed pretty quite receptive to that on the campaign trail. Again, we'll see what he puts forth as policy, along those lines. But I'm going to give you a couple examples. I think natural gas is probably a good example, Rajan. If you back up to 10 years ago, neither Canada nor the United States was exporting liquefied natural gas, LNG, as you've heard a lot about. You fast forward to today, and Canada still doesn't have an LNG terminal functioning. We do have LNG Canada that is being constructed and is on the verge of having its first shipment come out, in the fall of this year, and that'll be a milestone for Canada. But the U.S. has built 6 terminals already and are exporting out of 6 terminals now. They have 5 more under construction, and they have another 5 that have been permitted. Canada doesn't even have the one built yet and functioning. They do have 2 more being constructed and permitted, but that's where we're at. We have vast natural gas resources in Western Canada, and quite honestly, the rest of the world needs our natural gas. Asia predominantly burns coal to produce electricity. Natural gas is a far cleaner way to produce electricity. So there's a strong demand for liquefied natural gas in Asia. Europe had been dependent on Russia for cheap natural gas. That's no longer an option for Europe. The Middle East has been instrumental in supplying a lot of their natural gas needs. But I think Canada has a role to play. And, if we think about natural gas, not in terms of what are the greenhouse gas emissions that we will emit from producing more natural gas, but, how much will the rest of the world reduce their greenhouse gas emissions by burning our natural gas for their electricity needs is really how we need to think of it. Norway has taken such an approach. It's worked for them, and I think there needs to be a rethinking along those lines. And we'll see how the new Liberal government evolves in their thinking. On the other hand, you think about oil demand globally as well, and with all the talk of electrification of the world, you would think that oil demand is down over the last 5 years. But if you look at the demand for oil in 2019, so pre-pandemic, was about 100 million barrels a day. And fast forward to today, in 2025, it's expected to be 105 million barrels a day. So global oil demand continues to grow. But we have starved our oil companies from producing more oil. We've starved them of capital. In Canada, there hasn't been a lot of growth in the oil sector, if you will, because as shareholders and as capital allocators, we have preferred those companies to pay back that capital as shareholders rather than grow because that access to those global markets has been uncertain. So, 2 things: we like that return of capital from our companies, and we want them to return capital to us as shareholders, particularly as dividend investors. And we think that there's a discipline that comes to these companies with that allocation of capital back to shareholders. But number 2, we want our companies to think about diversifying, where they sell their natural resources. In this case, oil and natural gas. They'll continue to supply the United States with their needs, but I think we can export, off our shores into markets around the world as well.
Tim, quick follow up. You opened talking about natural gas. We've had on the podcast our resource boutique lead, Benoit Gervais, talked about how natural gas is critical to the energy transition. Now, let's move up a high level. I don't want you to choose between shipping the gas east or west. And in fact, I'm also going to park provincial or regional political concerns aside. What would you say is the biggest challenge facing the opportunity to build more pipelines and for natural gas to move?
Yeah, Roger, I would say it's the regulatory environment. Under the previous government, Bill C-69 really took its toll on the ability for new projects to come about, and not only oil and gas projects, but big projects generally. The permitting time on average under the Trudeau government was about 5 years, and now Mark Carney has pledged to reduce that permitting time to 1 to 2 years. So again, can that be done with Bill C-69 now being passed into law? It's hard to say. I think there's going to need to be a revision to some of the what was included in Bill C-69. But, at the end of the day, we need to get projects built in this country. If you're a company that's going to allocate tens of billions of dollars to a capital project, 5 years to wait for a permit is far too long. You're probably talking about 10 years for any new production of oil and gas under that scenario, and companies won't take that risk. So I think, regulation has to change. Um, and it's not only the time to market, but also, your project, the scope of your project. Under Bill C-69, things can be contested. Whether it's a Alberta or BC project. I mean, anyone out east can contest any sort of major project, and so these things just get caught up in agency oversight, court oversight. There's a lot of red tape that needs to be removed for projects to continue getting built in this country, whether that's oil and gas or infrastructure or otherwise. So um, lots to consider there.
Very good. Nice comprehensive overview and discussion on the energy complex. Thank you, Tim. Well, I'm going to bring you back into the conversation now. In your earlier remarks, you made reference to the Canadian banks. I think you alluded to how they've held up pretty well and how they're a decent proxy for the Canadian consumer. Curious broadly about valuations and what you think about the Canadian banks right now as an investor.
Yeah, valuations, and I will certainly bring Tim in the conversation as well. Tim is our bank specialist, so I probably shouldn't talk at all, but I'll make a couple of comments and then pass the torch over to Tim. Um, Valuations generally, though, reasonable, I would say, for Canadian banks. We've seen them cheaper, we've seen them more expensive. They're kind of middle ground for us right now. I think the big question really is the resiliency of the earnings stream, and that's the what we're looking at more closely today is just the degree of what we call provisioning for loans that go sour, what that looks like over the next year. You asked about investors. It's interesting. I think you've got really it's a tale of two cities in a sense. On the one hand, certain investors I think are willing to look through any degree of softness in the economy, any weakness, kind of looking forward to that 2027 period, even when we believe the banks will be, assuming all goes well with the economy, everything kind of comes out the other side. That kind of early cyclical dynamic with the banks. There's strong earnings power at the banks, as we know. I mean, over the long run, banks are phenomenally resilient and do an amazing job of kind of managing through the economic ups and downs. But that's the one question. On the one hand, certain investors willing, I think, to look through that, and that's why I alluded to this earlier. We've seen bank sort of valuations and the stocks generally being somewhat supported by that contingent of investors. I think investors that are a little more short term oriented are probably going to be worried about the next quarter's earnings, the quarter after that. It wouldn't surprise us to see those provisions, the PCLs, increasing, and that decreases the earnings stream. It's the degree to which the banks provision for those negative outcomes. I think that we'll need to be looking closely at. But I don't know, Tim, if you'd add anything to that.
Yeah, no, I think you covered it well, Will. The only thing I would add is, the banks are always a good representation of the Canadian economy. And, for a number of reasons, they are instrumental in capital formation in the country. They're the predominant lender into our economy. So, how the economy goes, I think, is how bank earnings go in some ways. And there is a lot of uncertainty right now. I think that there is an issue in terms of companies being able to allocate capital, not knowing the rules of the game in terms of the tariffs and how those tariffs are going to transpire, what will get negotiated away, how it's going to affect Canadian manufacturing companies, and how it's going to affect exports. Really, it's taken a bit of a toll on capital allocation in the country, whether that's business allocation or, quite honestly, even consumer allocation in terms of how consumers are spending their money. There's a lot of uncertainty out there. That does cause a slowdown in the economy. In terms of, Will and I both own, pretty large bank positions in the portfolios. Um, in the early part of the year in February, as the bank stocks had a really good run, we looked at valuations, we thought about the earnings outlook, and we actually took our bank positions down. They'd done very well. We've been rewarded. Now we're still invested in the banks, but we always think about that reward to risk profile. Are we getting rewarded for our target prices on these individual bank stocks for the risk that we're taking? Obviously, as the risk increased in the economic environment in Canada, our outlook for near-term bank earnings also waned, if you will, and valuations were pretty full. So it was good. It was a good time to take some of our bank weightings down. We continually assess that. These have been great investments over time. They are very high quality. They tend to mean revert in terms of their earnings. It's a well functioning oligopoly. And so we're invested in the banks. We just think about, where that marginal investment goes. Now, if you back up a ways, Rajan, I think there's been a lot of concern over the Canadian housing market over time. And, we've done a lot of work there in terms of is the Canadian housing market on the verge of a collapse? We don't think it is. We have always had a constructive view on housing. Can we use a price correction in housing? I think we can. I think affordability has gotten stretched, and we saw 30-year amortization mortgages and short terms and even variable rate mortgages becoming a bigger component of the overall mortgage market. So those were kind of signs of people stretching. So a price correction in the housing market would be healthy, but we don't have a situation like you had in 2008, 2009 in the United States that resulted in a housing collapse. We do not have an oversupply of housing units in Canada. There are select condo markets that are maybe oversupplied according to affordability, but that's small. We don't have an oversupply situation in general. In fact, we have an undersupply of housing. There's far more demand for housing than there are units available. So the supply side is fine, and then on the demand side, there's some concern over reduced immigration targets and what that will mean for the demand for housing. But you know, we've seen plenty of studies that show that immigrants, in particular, new Canadians, after 4 years of coming to this country, have the same home ownership rate as a Canadian. So if you think about our immigration rates over the last 4 years, they've been pretty strong. 2023 in particular was a very strong immigration year. So you still have this pent up demand that will be there for housing from our immigration policies of the past. So again, we're not concerned on the mortgage market whatsoever. The losses at the banks on Canadian mortgages is de minimis, and we think it's going to stay that way. Half of the Canadian bank balance sheets are residential mortgages. So obviously very important aspect of a bank's profitability and of their balance sheets, but we think they're fine in that regard.
Thank you for that detailed look at the banks, Tim. Really appreciate it. Will, just looking at our time, I think I'm going to wrap up our conversation with a final question with you. I'm just curious, both um, short, medium term, despite some bouts of volatility, Canadian equity markets have actually held up all right, it feels so far in 2025. What are you thinking, not just through the end of the year, but just your near-term outlook on the space?
Really difficult to call near term, I would say, Rajan, and it's not, frankly, something that we spend a lot of time thinking about. What we do spend time thinking about is investing in the companies that are going to be resilient over time. We've just talked about the banks. The banks are the foundation of the Canadian economy. You don't get a stronger oligopoly in a banking system anywhere in the world than you do see here in Canada. So the banks provide a strong foundation for our economy, and there's a number of companies, frankly, we think are global leading companies in terms of margins, in terms of management teams. The quality of these companies are very strong in Canada. So there's a fantastic investment universe for us in Canada, and I think that's going to help drive our markets forward. Canada tends to be a little bit slower, a little bit steadier, but dependable, and we don't see any change in that going forward for Canada. I think the opportunity, the incremental opportunity for Canada, is just what I alluded to earlier, this kind of kick in the seat that we needed to take us to that next level. And what I'm seeing and what we're hearing from management companies is that they are ready, willing to deliver on that. The opportunities are there. We're going to seek those opportunities. We're going to deliver on them. And I think it's going to take Canada to the next level.
That's encouraging. And on that optimistic note, I think we will wrap up our conversation right there. That's terrific. Will and Tim, I'd like to thank you again for joining the podcast, and I'm already looking forward to our next conversation. Thanks again.
Thank you, Roger.
Thank you.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.